Imagine you're holding onto a handful of cash during a storm. The wind is howling, and no matter how tightly you grip, those notes are slowly slipping away. Not because they're flying into the air, but because inflation is quietly eroding their value. Inflation is like a silent tax. It doesn't come with a bill or a notice in the mail. It just eats away at the power of your money over time. And when inflation hits high levels, investors everywhere start asking the same haunting question. Where can I actually put my money so it doesn't just disappear? Today we're going to break down exactly that, looking at different types of investments during inflation, from cash and savings, to long-term bonds, to growth in tech stocks, and yes, even the often controversial but fascinating world of blockchain and crypto. But beyond all of that, I want to highlight one critical thing. Why blockchain might not just be another speculative bet, but potentially an advantage in times when inflation threatens everything else. So grab a coffee, sit back, and let's unpack the truth about investments in inflation. When inflation strikes, the first instinct of many people is to hold on to cash. It feels safe, it feels liquid, it feels like you're in control. But here's the catch, your cash is actually losing value every single day. Inflation stays high. Let's say inflation is 8%. That means your $100 today only buys you $92 worth of goods next year. You didn't spend anything, yet your money got stolen. That's the invisible theft of inflation. Even savings accounts, unless they're offering insanely high interest rates, usually don't keep up. Banks might pay you 1 to 2%, while inflation quietly slices off 6 to 7%. The math isn't hard, it's a losing game. Cash gives peace of mind, but in the long run, it's like standing still while the escalator moves downward. Next up, long-term bonds. Traditionally, bonds are the safe corner of the investing world. Governments issue them, pension funds love them, and historically, they've been a place to earn steady, predictable returns. But during inflation, bonds can be a trap. Why? Because most bonds pay a fixed interest rate. Imagine you're locked into a 10-year bond paying 3%. Sounds okay, until inflation hits 8%. Suddenly, you're effectively losing 5% a year in purchasing power. Yes, there are inflation-protected bonds like TIPS, Treasury inflation-protected securities in the US. But standard long-term bonds often underperform dramatically in inflationary environments. It's like agreeing to run a marathon with lead shoes. You'll finish, but at what cost? When people get tired of watching their money erode in bonds and savings, they turn to the stock market, often to growth stocks. These are companies expected to expand rapidly, reinvest earnings, and dominate their industries. Think innovative startups, disruptors, the kind of businesses you see in headlines every week. But here's the rub. In high inflation times, growth stocks get hammered. Why? Because investors calculate their value based on future earnings, and when inflation and interest rates are high, those future earnings are worth less in today's dollars. Growth stocks are like shooting stars, dazzling in the right conditions, but in stormy inflation weather, they can burn out fast. Closely tied to growth stocks are tech stocks. These are the Apples, Googles, and yes, the riskier small-cap innovators. Tech is often seen as future-proof. I mean, who doesn't believe AI, blockchain, or space exploration will reshape the world? But in inflationary times, tech stocks are often punished harder than other sectors. Why? Because tech companies rely heavily on cheap capital to fund innovation. When interest rates rise, the usual cure for inflation, borrowing becomes expensive. That hits their growth potential hard. And yet, tech also has resilience. Companies with massive cash reserves, think Apple or Microsoft, can weather storms. But smaller, speculative tech plays, they can collapse under inflation's weight. Before we dive into the next exciting part, let's take a quick break for something really interesting I want to share. Unic has just launched their public token sale, the Unic IDO, in preparation for their upcoming token generation event. A total of $100 million UN tokens are on sale, starting at 15 cents, with the price gradually increasing as supply decreases. Early participants get an edge. Plus, there's a referral program with an 11% reward, 8% instantly in USTD, and 3% in UN tokens following a vesting schedule. And if you hold an Egg Ward NFT, you'll unlock a 25% discount to purchase UN. Available on marketplaces like Tensor, OKX NFT, and Magic Eden. This is not financial advice. Always do your own research, and you can find more details through the link below. Now let's get back to the part you've been waiting for. Now we arrive at the part that many traditional investors still roll their eyes at. Blockchain. Let's be honest, crypto has been called everything from a Ponzi scheme to the future of money. Its volatility is legendary. Prices rise and fall faster than you can say XRP, altcoin, or even Pudgy Penguin. But here's the fascinating truth. Blockchain as a technology and crypto as its front-facing application brings a unique advantage in inflationary times. Why? Scarcity. Bitcoin has a hard cap of 21 million coins. Unlike central banks, it can't just print more. This makes it similar to gold, which many call the ultimate inflation hedge. Decentralization. Blockchain operates outside traditional financial systems. When trust in central banks or governments falls, people look for alternative stores of value. Innovation in ETFs. With the rise of crypto ETFs, exchange-traded funds, blockchain investments are becoming more accessible, regulated, and mainstream. That reduces the barrier for regular investors. Community and adoption. Projects like WLFI or the growing NFT ecosystem, yes, even Pudgy Penguins, show that blockchain is not just about money, it's about culture, community, and digital ownership. Yes, blockchain is volatile, but volatility cuts both ways. And in a world where cash erodes and bonds suffocate, blockchain offers a bet on scarcity and innovation, two things inflation can't easily destroy. Let's stack them side by side for clarity. Cash and savings, safe but eroded. Long-term bonds, secure but underperforming. Growth stocks, potential but fragile in inflation. Tech stocks, innovative but capital sensitive. Blockchain/crypto. Volatile, yes, but scarce, decentralized, and innovative. No single option is perfect. The truth about investments in inflation is that every path has trade-offs. The real challenge for investors is to balance safety with growth and certainty with innovation. Inflation is not going away anytime soon. It might cool down, spike again, or linger in ways we don't fully expect. But what's clear is this: investors need to adapt. Cash is safe until it isn't. Bonds are steady until they sink. Stocks are exciting until interest rates crush them. And blockchain? Well, it's risky, it's bold, and it's controversial. But it might just hold a piece of the future that inflation cannot erode. And if you're curious about how blockchain projects are trying to make crypto investing safer, Unic OTC Exchange was born to bring transparency and security to over-the-counter crypto trading. Built on smart contracts, it aims to eliminate the scams and risks of traditional OTC deals, especially for pre-TGE tokens. Again, this is not financial advice. Always research, always compare, and check the link below if you want to dive deeper. So, what do you think? Is blockchain truly an advantage in inflationary times, or just another risky bet? Drop your thoughts in the comments, smash that like button if you found this helpful, and don't forget to subscribe for more fascinating deep dives into money, markets, and the future of finance. Because when it comes to inflation, the truth is simple. Doing nothing is the riskiest move of all.